two, but we can't have all three. Okay, so let's kind of understand market efficiency. Let's use market efficiency to understand these other crisis periods. So we saw with the Greek example that when Greece revealed this negative information to the market, that the market responded in a correct way. We saw that bank deposits fell. We saw that bond yields increased. And then we also saw that this was predictive and consistent with what happened with unemployment and GDP within the country. So we would think that the market was behaving efficiently. Now, we're going to look at some other crisis periods that have happened at different points in time around the world. We're going to ask ourselves, what is the new information? How did the market react? Did investors buy? Did they sell? Did the market overreact? So really, when we say overreaction, we're going to be focusing on contagion. And just like if you were to get sick or somebody has a flu or a cold or anything like that, and they're contagious and they're spreading it from one person to the other, it's the same idea within economics, within financial economics. Contagion. We're going to ask, does one economic crisis spread to another asset class or another country? Does the currency crisis spill over to the bond market, to the stock market? Does the crisis in country A spill over to countries B, C, and so forth? So let's jump in. The first currency crisis that we'll study is the Mexican peso crisis. So what happened? Mexico had high valuations and received lots of foreign investment after joining NAFTA. So after joining NAFTA, Mexico receives a lot of foreign investment. That foreign investment basically is going to increase your local valuations because, again, you have investors that are different. You have investors that don't face the same level of local systematic risk. So all things held equal, the firm's cost of capital is going to fall and valuations are going to go up. If we remember our present value equation from the start of the lecture, in our numerator, we've got free cash flows. So you enter NAFTA, you have higher free cash flows. And in our denominator, we've got the weighted average cost of capital. You have more foreign investment, your cost of capital is going to be reduced because of diversification. So both effects are going to push valuations up. On December 20th, 1994, the Mexican government announced it would devalue the Mexican peso against the dollar by 14%. How did the market react? There was massive capital flight. Foreign investors rapidly sold off pesos, stocks, and bonds. So we can see that the currency crisis jumped to other asset classes as they sold off stocks and bonds. Why? Well, the announcement lowered traders' expectations about the future value of the peso. By early January 1995, the peso fell 40% against the dollar. So from December 20th, essentially the end of December, to early January 1995, after announcing a 14% devaluation, the peso fell by 40%. The sell-off pushed prices even further than expected. It forced the Mexican government to float the peso, raise interest rates. So short-term interest rates were raised by 30%. Again, as we talked about, with contractionary monetary policy, many Mexican banks failed. Very difficult time. You have incredibly high local interest rates. You have very significant devaluation. And we also had contagion, not just within different asset classes, but across Latin America and Asian financial markets. So the peso crisis rapidly spilled over to many other countries. And the concern, what was expressed in financial press at the time, was that the market was not aware of the degree to which the Mexican economy was susceptible to capital flight. And that made people think and worry about other economies that might be susceptible to capital flight. So what does it look like? If we look, we've got dollars per peso, and we can see how there's a pretty steady price level and then a dramatic fall off with the announcement and then with everything that was going on in early January. Okay, The Asian financial crisis. So the Asian currency crisis led to contagion and severe economic and social costs. Many firms with foreign currency bonds were forced into bankruptcy, and the region experienced a deep and widespread recession. What happened? Well, it was triggered by the collapse of the Thai baht, which triggered capital flight from other Asian countries. Why? As capital markets opened up in the mid 90s, so as we have fewer capital controls and we have more access to Asian economies as foreign investors, there's large inflows of private investment that resulted in a credit boom in the Asian countries. Same reasons we just talked about with Mexico. We have a group of investors that face different risk, uncorrelated risk. They come in, reduce the cost of capital. The reduced cost of capital is essentially a credit boom for the local economy. At the time, there were fixed or stable exchange rates that also encouraged unhedged financial transactions. So because the exchange rates were fixed or were stable, as a market participant, as someone receiving a loan or as someone operating within one of the countries, I'm not really worried about hedging my exchange rate risk because they're all fixed. So the real exchange rate rose. And when that happened, because you have all this capital inflow, so you push up valuations, exchange rates increase. That exchange rate increase slowed down export growth. So higher exchange rates, exports become more expensive, they slow down, and as they slow down, there's capital outflow. So once that capital outflow occurs, those high valuations in the credit boom basically become busts. Those valuations become much lower. There's less credit that's available, so it's even harder to get a loan, and things just spiral. Many argue that if the Asian countries had been allowed to depreciate their currencies in real time, which wasn't possible because of the fixed exchange rates, that the sudden change in the Forex market in 1997 might have been avoided. What does this look like? So what do we observe? You can observe that in 1997, so here we've got the Thai baht devaluing, and then that triggers massive reductions in the value of the Indonesian rupiah, the Korean won. So, okay. Argentine peso crisis. In February 1991, the Argentine government linked the peso to the USD at parity. The initial economic effects were actually positive. During this time, the dollar appreciated, so the dollar had pretty strong growth in the second half of the 90s. As that happened, Argentina had low inflation, increased foreign investment, and an economic boom. Eventually, Argentina had to abandon the peso parity with the dollar in January of 2002. Why? Well, the strong peso hurt exports. Again, the same story. The currency appreciates, exports become much more expensive, and eventually they had to abandon that. And so once the government abandoned the parity, it led to a very long economic downturn. How did the market react? Severe economic and political distress. Inflation reached 20% per month. Unemployment rate rose above 20%. Similar story. So what do we observe? You can observe that the peso and the dollar are held at parity for many, many years. And then once the government abandons it, you can see how there's this massive devaluation as it requires more and more and more pesos to get $1. Okay. Our last example of a currency crisis is going to be the breaking of the pound. So in the UK, this is referred to as Black Wednesday. What happened? Wednesday, September 16th, 1992, the Bank of England announced that it would leave the European exchange rate mechanism. If you remember earlier, we had discussed how the ERM was intended to reduce exchange rate volatility and encourage economic unification within the Eurozone. So this was in the early 90s, late 80s. Why? Why did Britain have to leave? Well, Britain had experienced high inflation and high interest rates by keeping its currency pegged to the German Deutschmark. By removing the pound from the currency agreement, it would no longer be forced to keep the currency artificially strong. How did the market react? Many speculators bet that the pound would fall in value. The DAX, the German market broad index, think of the DAX as like the S&P 500, but for Germany, fell as Britain joined the exchange rate mechanism to encourage European unification. So the market received Britain abandoning the ERM as a sign, as a really negative sign about the prospects of European unification. So what do we have? We have a shock that happens in the UK in the currency market that spills over to a whole different asset class in a whole different country. So let's look. What am I showing you? The blue line is the dollar per pound. You can see that it's fairly highly valued. And then after Black Wednesday, it just falls. The green line is the DAX, the German index. Same story. You can see that over a 2-week span, the DAX essentially falls. So not everybody lost money. George Soros made a profit of almost $1 billion during the devaluation of the British pound. He bet that the currency would collapse despite the UK government's assurance to the contrary. Soros sold pounds, betting $10 billion that the prime minister would fail to keep the currency above its floor in order to stay within the exchange rate mechanism. He said, quote, "The depth of the British recession made the prime minister's commitment to keep the pound at just about 3 German marks untenable." Okay, so this is a great example of something that we'll study a little bit later in our term when we get into the limits to arbitrage and when we think about how market efficiency can push prices to react quickly and correctly. So what's the big picture? We should be comfortable with the international monetary system. We should be comfortable with fixed versus floating rates. And we should definitely know the trilemma, that you can't have fixed rates, capital controls, and independent monetary policy. You can't have all three. You can have two, you can have one, but you can't have all three. We know that with floating rates, it can be difficult to respond to a currency crisis, but you also are able to maintain national monetary policy. So there's a bit of a trade-off. We should also be comfortable with these currency crisis periods. There was kind of a similar pattern that we observed. There was devaluation. We saw an increase in foreign investment leading up to higher valuations, a higher availability of credit. And then once we encounter devaluation, we see capital flight. We see the foreign investment basically running for the hills. We saw the same story with the Mexican peso, the Argentine peso, the Asian financial crisis, and then also with the breaking of the pound. We should be more comfortable with market efficiency. We know from many of the finance courses that we're expecting price reactions to be correct. What might be new or what might be something that we're not used to thinking about is examining that market efficiency across different asset classes and across different investor behaviors. So we saw for the case of Greece that there was a reduction in bank deposits, and then we saw how there was an increase in bond yields, so forth. Also, we should be comfortable with the trade-offs of a monetary union. And again, thinking about the trilemma, we know that there's always going to be a trade-off. Lastly, a new concept that should feel hopefully intuitive now is contagion. The idea that an economic crisis in one country or one asset class can spill over to another. Our next lecture is going to focus on corporate governance. So I'm going to read chapter 4 We're going to talk quite a bit about agency concerns, tunneling, essentially stealing value from the firm, dual agency concerns. If I am a shareholder and I'm worried about another shareholder, what do I do? After we kind of build an understanding of corporate governance, we're then going to turn and ask about firm operations. So we're going to think about using financial options as a way of hedging our foreign exchange risk. Well, hopefully that'll be intuitive. And then we'll also think about real options as a way to understand foreign direct investment. So that's everything, and thank you.